Welcome to the deep dive. Today we're digging into the source material on Bellring Brands. That's ticker BRBR. You probably know them best as the company behind Premier Protein.
Yeah, and it's a really fascinating story because, well, there's this big paradox right from the start.
A paradox. How so?
Well, on one side, you've got this amazing financial success story. I mean, the business growth has been explosive, something like an 18% compound annual growth rate since they went public in 2019.
Okay, 18% CAGR. That's huge.
It is, but on the other side, you have this extreme fragility. The stock chart looks like a theme park ride. Punishing drops. We saw 18% wiped out one day.
Right.
And then, maybe even more shocking, nearly 33% gone in a single day back in August 2025. Just
Right.
collapsed.
Wow. Okay, so that's the core tension. Our mission today, then, is really to figure out how those two things can be true at the same time. How does a company get so good at growing, building these fantastic brands, but have an operational setup that's, well, seemingly so shaky?
Yeah, how does that slight hiccup just shatter investor confidence?
It starts, I think, with their basic model. The sources call it a very focused dual-engine business,
Little legend.
meaning two main brands, two approaches, operating this booming, convenient nutrition space. But the really critical part, the thing that shapes everything else, is their strategy. They use an asset-light joint manufacturing setup.
Asset light, meaning they don't own the factories.
Exactly. And that decision, that trade-off, it's foundational. It gives them high margins, speed, flexibility. But it also introduces some pretty significant structural risks. That's the key.
Okay, so let's tackle the growth part first. The sources use this analogy I liked, the barbell strategy. Bellring's going after both ends of the market, right?
That's a great way to put it. Think of a barbell. On one side, the big, heavy plate that's your scale engine. That's Premier Protein.
Household name. Absolutely.
Mhm.
And the strategy here wasn't to be some niche supplement for bodybuilders. No, they positioned it very deliberately as convenient nutrition for, well, almost everyone. The
Mhm.
focus was laser sharp. High protein, low sugar, and this was critical for breaking into the mainstream great taste.
Ah, the taste factor. That's always the hurdle with protein shakes, isn't it? Getting past that chalky reputation.
It totally is.
Yeah.
And nailing the taste. That was the key that unlocked the mass market. It reduced that barrier for people who weren't already, hardcore fitness types.
And the results speak for themselves.
Oh, definitely. Premier Protein is the #1 ready-to-drink RTD protein brand in the U.S. It's driving the fastest growing part of the whole convenient nutrition market. And look at the reach. Household penetration jumped from about 11% around the IPO
Mhm.
to over 20% of U.S. households now. That's huge penetration.
And the target audience is just incredibly broad. It's not just gym folks. You've got busy professionals grabbing it as a meal replacement, people focused on weight management, general active lifestyle consumers.
And even families. The sources mention they market it for kids aged 4 and up, is really aiming for protein for everyone.
Okay, so that's the heavy side of the barbell. What's on the other end?
The other end is Dymatize. This is the specialist engine, high-end, premium,
Hmm.
almost the opposite of Premier Protein's mass appeal.
Right, this is where things get a bit more technical. Dymatize is about uh, premium science-backed performance nutrition, core product, IS 100, #1 hydrolyzed protein powder. Okay, what's hydrolyzed mean for the average person?
It's actually pretty simple. Hydrolyzed just means the protein is already partially broken down, kind of pre-digested,
Hmm.
so your body can absorb it much faster, much more easily.
Ah, okay, faster absorption.
Exactly. That appeals directly to the really serious athlete, the fitness enthusiast who obsesses over the details, over performance metrics. They're also looking at things like BCAAs, branched-chain amino acids for muscle recovery.
So Dymatize targets the dedicated crowd, the ones willing to pay more for that perceived edge. Got it. But then, explain this collaboration they did with Post Holdings, their old parent company. The Pebbles cereal thing?
The Dymatize Pebbles protein powders.
Huh.
Fruity Pebbles and Cocoa Pebbles flavors.
That seems odd. Mixing hardcore performance with kids' cereal flavors, doesn't that dilute the Dymatize brand?
You'd think so, right? On the surface, it looks like a clash. But the sources show it was actually a brilliant move. Those Pebbles flavors drove something like 38% of Dymatize's growth in the year reported.
38%. Wow. How did that not hurt the premium image?
But it was strategic thinking about customer acquisition. It wasn't about changing the core Dymatize user. It was about bringing in a younger, maybe slightly broader sports nutrition customer. Someone drawn in by the fun flavor, the nostalgia.
Okay.
And once those customers were in the door, trying Dymatize maybe for the first time, the brand then had a chance to convert them later to the core stuff, like the high-performance ISO 100 powder. It just widened the top of their sales funnel.
Clever. Okay, so the brands are clearly well-managed, well-positioned. That brings us back to the origin story. Bellring started under Post Holdings, the big cereal company, back in the early 2010s. Why did Post spin off what sounds like its Star division?
Yeah, by around 2019, Post looked at the numbers. Their active nutrition division, which was mostly Premier Protein, was just exploding, growing over 20% a year.
20% plus.
While Post's traditional brands, cereals and stuff, were chugging along at maybe low single digits, the difference was just massive.
So you had this high-octane growth engine kind of stuck inside a much slower vehicle.
Exactly right. And in finance, there's a term for that, the conglomerate discount.
Right, I've heard that. The market undervalues the fast-growing part because it's lumped in with the slower stuff.
Precisely. The potential of the active nutrition part was being masked or dragged down by the overall slower profile of Post Holdings. So the IPO in 2019 and then the full spinoff in 2022, it was really a strategic play.
To unlock value, create a pure-play company focused only on active nutrition, letting investors bet directly on that 20% growth story.
That was the idea. But, and this is really important, it wasn't a complete divorce. The relationship remained unusually close.
Oh, so?
Well, Post's CEO stayed on as Bellring's board chair. Post still provides a lot of back-office services, IT, finance, things like that. And crucially, especially for what we'll talk about next, Post is actually building a huge dedicated factory just for Premier Protein shakes in Ohio.
Huh. So Bellring gets independence for valuation, but keeps the institutional support and scale of its old parent.
That's best, the best of both worlds in a way. And that continuing relationship is what really enabled the big operational trade-off we mentioned earlier, which takes us to Section 3, this tension between growth and fragility.
Right. The spinoff unlocked the growth potential, valuation-wise.
Yeah.
But the decision to stay asset-light, that's what fueled the speed of the scaling, right?
Yeah, not owning factories means you can pour all your resources into brand building, marketing, innovation. You can scale up production relatively quickly by just contracting with more third parties.
But the sources nail this as the big risk, the Achilles heel. Relying so heavily on outside manufacturers and also on huge, powerful retailers, it creates vulnerability.
It really does. It makes them susceptible to something called the bullwhip effect in supply chains.
The bullwhip effect, explain that a bit.
Okay, so imagine a small change in actual consumer buying patterns at the shelf. Because Bellring doesn't directly control all the inventory sitting in retailer warehouses, the retailers might overreact to that small change. Maybe they think demand is slowing slightly.
Yeah. Mm-hmm.
So they abruptly cut way back on their orders to Bellring to burn through the stock they already have. That sudden stop sends a massive shock, like cracking a whip, all the way back up the supply chain to Bellring. Much bigger than the original change in consumer demand.
And this isn't just theory. This is exactly what happened in 2025 and caused those stock crashes we talked about.
Precisely. Let's walk through that timeline. It really shows the fragility. In May 2025, Bellring first announces that some key retailers are deliberately destocking. Basically, trying to hold less inventory, fewer weeks of supply on hand.
Okay, first warning.
Yeah, Bellring called it a headwind. The stock dropped 18% almost immediately. That was the first tremor.
But then things got much worse over the summer.
Oh, yeah. By August 2025, the company had to come out and admit the destocking was way worse than they had expected. Their adjusted net income just cratered down over 71% compared to the year before. Investors basically panicked.
71% drop in income. Yikes.
Yikes is right. That's when the stock absolutely collapsed, down almost 33% in one day. And it triggered securities fraud investigations, too.
So what was the fundamental problem there?
It exposed this huge gap between two different kinds of sales metrics. There's sell-in, which is what Bellring sells to the retailers. That's what Bellring reports as revenue initially.
Got it.
Then there's sell-through, which is what the retailers actually sell to the end consumers at the checkout.
Ah, okay. Actual demand.
Right. Bellring had been reporting strong sell-in numbers, shipping lots of product to retailers. But meanwhile, inventory was piling up in the retailers' warehouses because sell-through wasn't keeping pace. The retailers were sitting on too much stock.
So a failure of inventory management across the whole channel, but it's kind of baked into the asset light model, isn't it? They don't have that direct control or visibility.
That's the inherent risk. They could see inventory was high, sure, but they couldn't force retailers to order less earlier or force consumers to buy more. Their hands were tied, to some extent, by the structure.
So what was the fix? What did they do after that crisis?
Well, the immediate reaction was a massive focus on fixing the supply chain, getting better visibility, better planning, building what they call a scalable and regionally diverse supply chain.
And that new factory Post is building for them in Ohio must be a huge part of that.
Absolutely critical. Having a dedicated facility, even if operated by Post, gives them a level of stability and predictable capacity they just didn't have, relying solely on a network of third parties. It helps insulate them a bit from that volatility.
So they're basically using capital, investing in capacity to mitigate the risks they initially accepted to achieve that asset-light growth. Interesting dynamic. Okay, let's shift to the financials then, because despite all this drama, the underlying growth really is still impressive when you zoom out.
It genuinely is. Think about the scale change. Near the IPO, sales were roughly $850 million. Fast forward to fiscal year 2024, and they're knocking on the door of $2 billion.
Wow, more than doubled in about 5 years.
Yeah, that's that 20% year-over-year growth in FY24,
Yeah.
smashing their own long-term targets, which were more like 10–12%. The demand engine is powerful.
And that growth spins off cash, right?
A good amount. About $200 million in operating cash flow in FY24. And importantly, look at what they're doing with that cash. Big share buybacks. They spent $147 million buying back their own stock.
Which is usually a signal from management, isn't it?
It's a classic signal. When a company with this kind of growth profile sees its stock price get hammered, maybe trading at a low price, Bellring was around 19 or 20 times earnings. Then management stepping in to buy back shares aggressively says, "We think the market is wrong. We think our stock is cheap right now, and the volatility is temporary."
Okay, so connecting this back to the wider market, they've got strong growth. But what are the big forces shaping their world?
Well, they've got a massive tailwind, which is just operating in this enormous $86 billion global convenient nutrition market. It's growing fast, projected 9% CAGR, almost doubling by 2031. Busy lifestyles, protein going mainstream, it all helps them.
Huge market potential. But there must be headwinds, too.
Oh, big time.
Oh, yeah.
And these headwinds really underscore that operational fragility we've been talking about. Bellring gets squeezed from both sides. Well, first, they face really high bargaining power from their buyers, the big consolidated retailers. The 2025 inventory crisis proved just how much power those retailers have to dictate terms, to destock when they want.
Okay, pressure from the retailers. What's the other side?
Pressure from suppliers. Key raw materials, especially whey protein, come from just a few large global suppliers. That concentration gives those suppliers pricing power, and it makes Bellring vulnerable to wild swings in commodity costs. We saw whey prices jump around by over 40% in just 1 year, back in 2023.
Wow. So caught between powerful buyers wanting lower prices and powerful suppliers pushing costs up. That sounds tough. What's their defense against that squeeze?
Really, only one thing: massive brand equity.
The power of the brand itself.
Exactly. Premier Protein has something like 30% market share in its category. That means retailers pretty much have to stock it. Customers expect it, demand it. That consumer pull is the only real leverage Bellring has against the retailers and, to some extent, the suppliers. At the end of the day, they are a brand and marketing machine first, an operations company second.
Okay, that really brings us towards a final synthesis then. Bellring Brands. They use that pure play spin-off brilliantly to capture investor interest, escape that conglomerate discount, and just fuel incredible growth. World-class branding in a market that wants what they sell.
Absolutely. But the strategic choice to stick with that asset-light model, while great for speed and margins initially, introduced this fundamental structural risk. We saw that risk bite hard in 2025. So the paradox kind of resolves itself. The volatility is almost the price they pay for that specific model of rapid growth.
And looking forward, the sources seem to suggest their biggest challenge isn't really creating more demand. They're masters at that. It's about building the operational resilience, the predictability to actually meet that demand consistently without these damaging shocks.
Yeah, that's the immediate operational challenge. But I think the sources also leave us with a really interesting, maybe more profound final thought to consider. It goes beyond just inventory levels.
What's that?
While the clear and present danger is supply chain hiccups, maybe the bigger, longer-term structural threat is the classic Porter's 5 forces element, the threat of substitutes.
Substitutes, meaning alternatives to their products.
Specifically, alternatives to their core ingredient. Bellring's dominance today, especially Premier Protein, is built very heavily on dairy-based protein, mainly whey.
Okay, right. Most protein shakes are whey-based.
But what happens if consumer tastes shift? What if there's a really rapid, decisive move away from dairy, maybe towards plant-based proteins or other alternatives in the future?
Good question.
How quickly can a company like Bellring, whose strength is branding and marketing, not manufacturing, pivot its entire supply base? A supply base it doesn't even own to defend its #1 spot in what could become a radically different market.
Wow.
That's the real long-term, multi-billion-dollar question that has to be keeping management up at night.